So we had a good correction, a good bear market ended on April 8th. Between April 4th and August 13th, quite a number, probably more than 50 separate buy signals. We cannot at this time consider the gains of the November 20 low as anything more than an oversold bounce of little technical significance for the intermediate term.
So I think investors right now are just looking forward to your guidance, or looking for your guidance on what to do exactly.
Well, obviously, they're easy.
It's my pleasure to welcome back to the show Milton Berg. He's the founder of MB Advisors. Milton's been working on a proprietary market model for quite some time, many years, he's told me, and now he's finally ready to launch it, use it, and share with us how it works. And we'll be getting his outlook based on his model. We'll talk about how the Fed has impacted markets or may impact markets. We'll talk about any other macroeconomic drivers that Milton thinks are important. Welcome back to the show, Milton. Good to see you as always.
Good to see you, David.
I'm very happy. Yeah, thank you. Thank you. Good to see you. I'm very happy to be able to share with my audience this proprietary model you've been working on. We're going to talk about that. I want to start by talking about what happened yesterday at the Federal Reserve Open Market Committee meeting, and we'll talk about their decision. So here is an article that highlights one of the key decisions that they've made. They will start reserve management treasury bill buying, said it would start buying short-dated government bonds to help manage market liquidity levels to ensure the central bank retains firm control over its interest rate target system. The technically oriented purchases will commence on December 12th, the central bank said, as part of the policy announcement associated with its latest FOMC meeting. Now, Milton, the market was interpreting yesterday's move as relatively good news, as you're aware. Stocks went up, and some people are calling this the beginning of a new round of quantitative easing. I don't know if it is. We'll let you comment on that. And generally speaking, whether or not this decision, among others, to ease the rates, for example, have anything to do with your long-term outlook for the markets.
Well, obviously, they're easing process over the years. It's been assumed that when the Fed is easing, it's bullish for markets, and that's generally been the case. It's not always been the case. They're easing throughout the 2008 to 2009 decline. But generally, easing is positive. Generally, quantitative easing, when buy treasury securities, it is liquidity. Generally, it's positive. So I have to say, yes, the market reaction was positive. The bank stocks made a new all-time high yesterday. The small cap stocks, the Russell 2000, which had been lagging for 2 years, it's finally at an all-time high. So I'd say the market is telling you that it's positive. In reality is the Fed should really focus more on inflation, in my opinion. Inflation is still too high. The target shouldn't be 2%. The target should be 0%. And then you'd have a much healthier economy and probably a far healthier markets. You won't see bubbles if the Fed will allow inflation to get down to zero. But they're not. It's 2.8, 2.9%, and they're still easing. So classically, this is considered bullish. Whether or not there could be some black swans along the way, that totally can't be predicted.
You were on the show a couple of months ago, early in the year, actually. I'm just going to quote an interview with me from March. Back then, you'd said the market had bottomed for now, but long-term, you remain cautious. You said that a bigger bubble, potentially bubble pop or crash awaits. We have had multiple corrections along the way, especially along October and November, especially within the crypto markets, which underperform stocks overall, in fact, are down year over year. Is this bubble pop that you spoke about earlier in the year, has that already happened, Milton?
Well, it certainly hasn't already happened. What we do if we're going to get a pop bubble or a market crash, I mean, if the market's not even down 4% or 5%, you might as well wait for the market to be down 8% or so before you start worrying about is this a crash or not. If you're trying to trade for short-term moves, we had a good correction, a good bear market ended on April 8th. That was a bear market in terms of the extent of its decline and the kind of pessimism we saw at the lows. We had just slight correction in the S&P, not even anything more than 5% since the market started rallying. You did see an 8% decline in the Russell 2000. This is basically a bull move that started in April. It seems to be continuing. Again, the background definitely long-term seems very, very negative. I mean, everything is overpriced. There's tremendous leverage in the system, and eventually it will pop. but it's probably best to wait for it to see the first signs of popping rather than to anticipate it. I mean, there have been people in the business, you probably know some of them, who've been talking about this bubble popping for the last 15 years. It's best to wait for it to go down 8-9% and then decide, well, is this just a correction or is this just a bear market? We think that we had the April decline showed up as a classic concentrated bear market, and we had amazing buy signals at the lows. So we have to assume the market's going to get higher. Now, we don't try to project necessarily how high the market's going to go. We have indicators that tell us either the market has bottomed or the market has topped. Currently, we saw many indicators in April, May, and even in August telling you that the market has bottomed and it's headed higher. But the underlying technical data, which we have a 4-page spreadsheet called Technicals at the High, are all consistent with what you see at all major market peaks in the past, whether it's valuation, whether it's interest rates, whether it's breadth and so on. So it's quite possible this bubble could pop at any time, but there's no evidence that it's happening at this time. As far as Bitcoin goes, I've been a Bitcoin bear all along. It never made sense to me. It still doesn't make sense. We currently have a short position, a recommended short position in strategy. We're actually doing quite well in that short position. And I think it's possible that the Bitcoin bull market has ended. Whether or not it will go down to 10,000, 5,000, or 90,000 or 85,000, we really don't know. But the evidence is, my distant relatives have been calling me about Bitcoin over the last few months, whether they should buy it or whether they should buy any more. They already had some. A relative of mine put $1,000 in Bitcoin. It's worth $2,000, and she's all nervous. Should she get out of it or not? Should she buy more? So I think the public has been too involved in Bitcoin. Bitcoin is a very sophisticated asset class. The fact that the grandmothers all over the country and over the world have been buying Bitcoin suggests that it has the type of speculative fever that you see at market bubbles. And whether or not this looks like it's quite possible that it popped, and it quite possibly we won't see the highs for quite a while. I mean, there's some analysts going over there talking about $1 million Bitcoin, and there's really no basis to value a Bitcoin. You could value gold based on its industrial usage, based on its jewelry usage. You could value copper. You could value oil based on whether it makes sense to purchase the oil to use to get energy. But there really is no way to value Bitcoin. If it goes to $1 million, I mean, if Bitcoin would go to $1 million today or goes to $10 today, you really can't analyze based on any underlying valuation, just based on supply and demand. So it's a very difficult asset. It strictly moves on technical, does not move on any fundamentals. It had quite a nice pop. By the way, it peaked on one of our cycle dates. People don't like me to talk about cycle dates, but we have a number of cycle dates each year in which markets are prone to reverse. And the October 10th peak in Bitcoin was on a major cycle date. The cycle dates were not developed by me. It's developed by one of my mentors, Paul Montgomery. And, we have cycle dates going out for the next 100 years. So it's not something we really have to create. We have to model for. But the fact that Bitcoin peaked on October 10th, the fact there was so much speculation in Bitcoin, it suggested that perhaps the high in Bitcoin will last for quite longer than the Bitcoin bulls expected to last.
Before we jump back into the video, let's talk about something most people ignore, but is very important: your online privacy. Your personal information isn't just sitting on your phone or email. It's being scraped, bought, and sold by data broker sites every day online without your permission. Our sponsor today, Delete Me, helps you take that control back. They scan the web for your exposed information, send you regular privacy reports, and remove your data from hundreds of broker sites so it can't be used against you. And in their latest report, they reviewed over 325 listings to see if any data broker had my personal information, and they continue to check every week to make sure it stays off. Go to joindeleteme.com/DavidLin and use promo code DavidLin at checkout, or scan the QR code here on the screen. Get 20% off on all US plans. Take control of your privacy today. There's a narrative out there that Bitcoin moves as a leading indicator to stocks, and the fact that Bitcoin has fallen so much is a leading indicator for how stocks will perform in the next coming months. Is there any truth to that?
I think there's no real proof to that. We've had a bull market in stocks, basically for quite a number of years. We had a bull market in Bitcoin for quite a number of years, but I don't see any real correlations, except for logically, Bitcoin's going to move on liquidity, and so stocks move on liquidity. See, the stocks can move for fundamental reasons, and stocks can move strictly because there's money in the system that has to go somewhere, and ultimately it ends up in stocks, and some of it ends up in Bitcoin. So as far as that's concerned, yes, probably a crash in the stock market and it would be associated with a crash in Bitcoin. If people have to meet margin calls in the stock market, they have to sell the Bitcoin to meet the margin call, or the other way around. If they meet a margin call in Bitcoin, they may have to sell the stock. So usually, if the market will decline on a liquidity basis, there'll be tightening in liquidity. There's a reason to believe that both Bitcoin and stocks should move down at the same time.
All right, excellent. Milton, let's talk about your model and why you're feeling the way about markets the way you do. So
this is basically, we had quite a number of buy indicators between April 4th and August 13th, quite a number, probably more than 50 separate buy signals between April 4th and August 13th. We positioned long on April 8th for our clients after being shorted to the decline. April 8th was the day of the low. April 9th was the first upside day after the low. And we had quite a number of models. What I'm trying to do is to show that the signals we've gotten from April 4th through August 13th are signals that were generated historically in the market as well. This is a chart. I'll read what I wrote. From April 4th to August 13th, 2025, our model generated a series of buy signal indications. Again, there are over 50 buy signals, which had in the past signaled on the 104 dates highlighted below. So just to review this again, we have models which is very dissimilar to anything you've seen on Wall Street, but whether it's fundamental or technical models. And these models signaled between April 4th and August 13th. And we're going to show these models how they've done in the past. And in fact, there are many, going back to 1957, as you can see, the same model, the signal in the short period from April 4th to August 13th, have given us multiple signals in the past. So that's really the first point I'd like to make. David, am I clear about this chart?
Yeah, very clear.
Chart is showing dates of buys, and you can't see all the dates. But for example, you see a date of March 27th, 1980. That was after the Bunker Hunt collapse. We'll get that in a moment. But this is a chart basically showing that what we saw from April 4th to August 13th is not something unique and new, but it's something we've seen historically in the market going back to 1957 many, many, many times. So that's the first thing we want to show. Now we're going to show you a little bit about those signals, these dates you see over here. We're going to show them one by one. So let's start October 21st, 1957. One of the models that signaled on April 8th also signaled on October 21st, 1957. We're going to get to the models later on. I first want to show the concept. So one of the models that signaled April 8th also signaled April 21st, 1957. And in 1957, the market gained another 55% before its next 12% correction. Okay? The drawdown was minus 0.43%. That's that particular indicator. So a model signaled in 1957, the market went up 55% before it next had a 12% correction or a 12% decline. And the pullback after the signal was only 0.43%. Now, the next date is October 23rd, 57. It's the same idea. It's something signaled April 9th, also signaled on October 23rd, 57. Next is June 26, 1962. The market had declined 27.97%. On the day of the low, we got a buy signal, which is the same buy signal we got on April 8th. Now, what the signals are, we'll get to later on. I first want to show the concept of what I'm pointing at is what we've seen now, we've seen in the past, and there's reason to believe the kind of action we've seen in the past should continue currently, which is the future from 1962. 1970, the market was down 36%. A couple of days after the low, we got a signal. That was the same signal we saw on April 9th of this year. And let's go through 1970. Let's go to 1974. The market had a major bear market down 48.20%. That's when you had inflation, and you had Fed starting to tighten, and you had a recession, a major collapse. It was really far worse than 48%. The over-the-counter stocks were down on average 85 to 90%. They didn't have the Nasdaq then, but you had an over-the-counter index, which people got was decimated. In any event, what signaled on October 11, 74 also signaled on April 24th, 2025. In that instance, as you see, the low was already in. The market tested the low, but the market was up another 51% before it declined 15%. It was only up 5% before this correction. This correction was really just a test of the prior low. This signal told you that the low was in. There was fluctuations, but the low was in, and the market gained, 51% before the next 15% decline. That's 74. Let's go to the next period. This is 1978. This is also signal on April 9th, signal on April 14th, 78. Market gained 15% before the next 12% correction with a 0% drawdown from that signal. Let's go to the next. This is a very important date. I know most people watching probably weren't in the market at that time. I happen to have been in the market. And March 27, 1980, what I call the Bunker Hunt collapse. One of the richest men in America was, I forget his first name. His last name was Hunt. Maybe I forget his first name. And he was trying to corner the silver market. And he got caught. Basically, the people on the board of directors of the COMEX decided to call in many trades. They didn't allow any leverage. Anyone who was using margin to buy silver had to liquidate. And silver went down from roughly $50 to $5. And the stock market was down 27% over a short period of time. And in this case, it bottomed on March 27th. We got a signal on the exact day of the bottom. And the same signal we got on April 8th, which is the exact day of the current bottom. But this is a very interesting market because the market bottomed, rallied, and then a bear market began that same year. So you had a correction of over 20%. The market rallied, and that was the final peak. And you had a bull market, bear market into 1982. The bottom of 1982, which was really the beginning of this great bull market that was started in August of 82. What signaled then on August 17th, 82, also signaled April 9th, 2025. In this instance, the market was up 58% before its next 12% correction. And the maximum loss pullback was 0.47%. You go to 84, which is another instance. The market only declined from 15% into the low. The signal April 9th, the same signal got August 2nd. The market went up 113% before its next 12% correction with a 0% pullback. In other words, this signal never had any pullbacks. Go to 84. Let's go to 87. Before the crash, April 9th, 87, you got a buy signal. The market's up 33% before its next 12% pullback with a 0 pullback. Again, this was signal on April 9th. January 7th was something that signaled April 11th of 2025 and same kind of returns. Let's go to something people are more aware of, which is let's go to 2000 to 2002 the bear market, the dot-com crash. We had a buy signal during the decline. The market was down the S&P was down 27% into April 5th. And we got a buy signal. The market gained 14% in 31 days with a 2% drawdown. And of course, then it went down lower and lower. But the fact that the buy signal during the bear market gave us a 14% rally. Then you got another signal in the bear market, September 20th, 2001. That's when you had the infamous 9/11 terror attack in the United States, which seems to be forgotten by many people. But in any event, the market bottomed during a bear market. It had been down 36%. It gained another 19% before the next 12% pullback. So although we got a signal during a bear market, this was signal April 8th. It was followed by a strong gain of 19%. And let's, just to get a little further, give you some better idea of what's going on, let's go to, I can't go through every date. Let's see 2020. Let's see 2018, first of all. We'll go to 2020. They had the COVID crash 2020. On March 20th, which I think is the day before the low, we got a buy signal. This is the same signal you saw on April 7th of 2025, April 8th, April 9th, and April 10th of 2025. The market had been down 33.92%. It pulled back 2.93% the next day, and then rallied 108% before the next 12% correction. So I'm just trying to give you a flavor of what the models are doing for us. The models aren't just looking at what the market is doing, giving an opinion of what they think is going to happen based on the Fed, based on the economy, based on our recession. We have data that goes back to 1957. The reason we use 1957 rather than 1928, because the S&P did not begin in 1928. In 1928, it had 90 stocks. It first became an S&P 500 on March 4th, 1957, and the technical data is totally different now than it was then. So we only use data starting on March 4th, 1957 to create our models. We don't use data prior to that, and some technicians still try to use data back to 29, but that sort of screws them up because it's a different market. And it's a different index. It's from 90 stocks to 500 stocks, much broader at this point. Okay. So I think I've completed. Now let me show you the card. So we got a buy signal on April 4th. This is our current market. April 4th, the bear market was 18.9% in the S&P. This signaled 2 days before the low. The market declined 1.80% over the next 2 days. So far, it's getting 35.81%. So this signal has worked very well. And I showed it in the past, it worked well as well. We got a signal on April 7th, which was 1 day before the low. The market gained 36% before. It never had a 12% correction yet, but it's down 1.57%. Its greatest pullback since the signal was 1.57%. April 8th, another buy signal. The market's up 38.29%. That was the day of the low. So, of course, there's no pullback. That was the day of the low. So far, the market's up 38.29% subsequent to that signal. We got a signal April 9th, many signals April 9th. The market declined corrected 5.47% in the test of the low and didn't get very close to the low. And the market's up 26.28% from that date with a pullback of 5.47. Another signal April 10th, signal April 11th, signal April 22nd, April 24th, April 30th, May 5th, May 16th. May 16th signal had a 2.61% pullback, up 15.65% so far. We don't know if the top is in yet. And the final signal is August 13th, 2025. The market's only up 6.56% since then. It's only 53 days. And its pullback was only 1.49%. So this is giving you a general background of what the models should do. I haven't yet told you what the models are. What is this model? What is this crazy model that Milton Berg thinks spent 10 years developing, which he believes is sort of like the holy grail, going to be the holy grail of this market? I want to keep it very proprietary. I don't want to share it with too many people. We have institutional clients, and they also haven't seen all of this. They just see a little bit of what we've done. But now we've completed the project. I want to give some idea of what exactly going on. Is this voodoo? Is this logic? Is it magic? Is it technical analysis? What exactly is this? So we're going to
can you just show the interface of the model? Like, what does it actually look like? Because
I'll show you right now what the model is.
All right, let's do it.
That's the next step. Now, the model is not a model. You see, what people generally do in this business is they find a model, whether it's a crossing of a moving average, whether it's numbers of highs relative to the number of lows, whether it's what number of high volume relative to the low volume. No, it's not one model. We've created, using 30,000 indicators, we've created over 2,000 models that have been successful in calling market bottoms. Now, market tops is a separate issue. I'm going to discuss that later on. We're just talking about market bottoms. Now, you know, the most difficult time to invest is at a market bottom, and it's the most profitable time to invest because the stock market spikes at the lows, doesn't spike at the tops. It spikes at the lows. You know, you miss the first few days of a bull market, very often giving up your return for the year or even for 2 years. So we've created nearly 2,000 models based on 30,000 indicators. It's not one model. It's basically, we've modeled the market. We've modeled the market from 1957 through the current period. And what we found is what type of indicators occur at turning points, specifically at turning points in which you want to buy stocks. We ignore what to sell stocks for now. So let's look at we're going to go through some of the models, give you some idea of what we're looking at and how this works. April 4th, 2025, we said we got a buy signal. Now, what was that buy signal based on? What was this model based on? Number one, the NASDAQ's 5-day volume was its highest in at least 200 days, okay? That's a very rare thing to see the 5-day volume of any index have a 200-day high, okay? So this is a very rare thing, and it's generally seen at trading points, this type of high volume. Next, the NASDAQ declined 7% over a 3-day period. Okay, also very, very rare. I mean, how often do markets decline 7% over a 3-day period? And the VXN, which is a VIX on the NASDAQ, VIX on the NASDAQ, gained 10% for 2 days in a row. Okay, now, this has occurred 3 times in the past. The 4th time was in April. And let's see what these are going back to the dates I showed you previously. So, for example, the S&P was up 100% at a time, 2 days, 3 days, 4 days, 5 days, 10 days, 15, 30, 40, 60, 90, 120 days out. It's up 100% of the time. Now, let's see what exactly this is. October 8th, 1998, the same 3 indicators occurred simultaneously. August 24th, 2015, the same indicators occurred. In 1998, the market gained 47% before the next 12% pullback. And in 2015, it was at a bottom area. The bottom in February was only 2% below the bottom in August, but the market gained 11% before the next 12% pullback. And it signaled on August 5th, 2024, last year, after a correction of about 7%, the market gained 18.468% before the next 12% pullback, with a zero pullback in the market before the gain. And it signaled April 4th, 2025. So these 3 indicators are 3 simple indicators. Highest volume in 200 days, the VXN, the VIX for the NASDAQ up 10% 2 days in a row. And the third indicator was the let me get to the third indicator was the NASDAQ down 7% 3 days in a row. That alone only took place these 3 times in the past. Each time the market rallied, and again, market rallied on April 4th. And our retail model, which we'll get to later, is officially long since April 4th. We're long the market on the retail model, which we haven't really marketed yet. We hope to market in the next few days. That's been long since April 4th. We have no reason to get out of the market. That's one signal on April 4th. Okay. Now we have a signal on both April 4th, 7th, and 8th of 2025. And again, the NASDAQ 100 5-day volume is highest in 200 days. And the NASDAQ was declined 7% over a 3-day period. But instead of using the VXN up 10% 2 days in a row, we're looking at the S&P VIX. Looking at the VIX, its level was somewhere between 45 and 60. In other words, there's a spike in the VIX, far greater than you usually see in the VIX. The VIX average is about 15. It was between 45 and 60 on that day, and this signaled 3 days in a row. So we got a buy signal on April 7th. Basically, as you can see, the market's now 100% of the time, 120 days later. And you got a signal on August 8th, 98, August 8th, 2011, which is at that bottoming period. The market gained 90% before its next 12% correction. Pullback was only 1.80%. And it signaled on April 4th, signaled on April 7th, signaled on April 8th, and signaled those 3 days. So again, another reason to buy the market, another model. Rather than using the VIX up 10% for 2 days, we're using the level of the VIX, and the level is between 45 and 60. Now we have another signal that also signaled on April 7th, 8th, 9th, and 10th, 2025. But again, it signaled in the past. So this signal is basically the 5-day New York Stock Exchange volume was the highest in over 375 days, sometime in the past 20 days. And what does that mean? We're looking for a high volume regime. We're looking for a market that is creating higher than average volume. Now, you not necessarily have to see the higher than average volume on the exact day of the signal. We're just saying as long as sometime in the last 20 days, the 5-day volume of the New York Stock Exchange was the greatest in 375 days, this signals as an indication of something's happening underlying the market. On top of that, we have an oscillator. You put the NDR's oscillator was 10 or below, which is an 18. They have an 18 oscillating. We've adjusted a little bit for ourselves, but for purposes of this presentation, we're using NDR, which is Ned Davis Research. The oscillator is 10 or below. And the NASDAQ new highs minus new lows. You look at the number of highs, the number of lows. On a 5-day basis, was minus 16, which is a strict oversold reading. And again, basically, what you see here is a buy signal on April, in the past on September 1st, 1998, up 42%, 3.5% pullback. You saw that December 24th, 2018, up 44%, no pullback. You saw it on 26-18 a few times, March 20, 2020, 1 day before the low, pullback of 2.9%, a gain of 108% before the next 12% pullback. And you saw it on April 7th, the market's up 36% since then. You saw it on April 8th, the market's up 38%. You saw it on April 9th, the market's up 26%. You saw it on April 10th, the market's up 30% since then. So again, we don't have a model. We've modeled the market. The market gives messages at turning points. And listen, how did we discover that this could work? I put 10 years into it, having confidence that I could be able to model the market. I don't know anyone else has ever been able to model the market in this way.
What's the backtesting result, Milton?
I'm showing you the backtesting result. This is what you're seeing. You see every time this happened in the past, every single time. Each indicator you're seeing is showing you when in the past have you seen the same combination of rare indicators occur. And interesting enough, it occurs at the time when it's time to buy markets. Now, you've heard of all this. You hear people say capitulation at the low, but no one ever measures the capitulation properly. You hear people say, oh, people are panicking, volume is up. That's true. How high is it up? 5%, 10%? Well, the highest volume in 3 years, you see? So we've modeled the market. We have roughly 2,000 models that go back to 1957. And the rarity is actually the blessing here, because what you're looking, if you're trying to, I don't know what a good example to give you. You want to bomb a building. If you use a 10-ton bomb, it's going to collapse. If you use a 100-ton bomb, it's certainly going to collapse. But it's far rarer to, what I would say is it's a rarity of the signal that gives it its benefits. So people say, well, how can you rely on a signal only happened 3 times in the past?
That's what exactly I meant was, have you had the chance to use this model, use the indicators, and backtest the performance of a trader or investor if he had traded on every single one of these signals?
Yeah, I have that. I'm going to show you that in a moment. But
all right,
you're missing something in that question, because I haven't told you when you get out of the market.
Oh yes, very key. Please go ahead.
I only told you that the bull market is ahead. What you want to know, what we're saying is investors want to know that now's the time to buy stocks. When is it the time to sell stocks is a separate question, and we're not getting into this question at this moment. I'm just trying to. Other than that, the back test is right here in your face. Let's get the back test. Let's take this signal, April 8th. Let's take one that has more. Let's take one that has more historical signals, make it a little more exciting. Let's take this one here. Okay.
All right.
This one here has it happened 6 times in the past. It's signaled on April 8th. Okay, very simple. Nasdaq's 5-day rate of change is weakest in 1,260 days, which is a 5-year period. So basically, you talk about capitulation, you talk about signs of low, signs of panic. Nasdaq's 5-day loss was the weakest performance in the Nasdaq on the 5-day period in 5 years. Extreme. Secondly, is we have a new measure of the AD line. I'll give it away. No one has heard it before. People look at the AD line saying, well, how many stocks in the SP were up on the day? How many were down? Or how many stocks in the Nasdaq were up on the day and how many were down on the day? Well, that's a nice indicator to use. I don't think people have been very successful in using it. But what we decided is I don't care if a stock's up or down. Why is it only up a penny on the day or down a penny on the day? Why is it only up 0.25% on the day or down? Why should that mean anything? There's no rarity in that. There's nothing special about that. So what we did is we looked at our advanced decline line is built on only stocks that either up 0.5% or down 0.5% on the day. You got the difference? The typical advanced decline line measures any stock that's up on the day is positive. Any stock that's down on the day is negative. What we do is we're looking only for stocks that are up more than 0.5% in the day relative to stocks that are down more than 0.5% in the day. And we got an oversold reading on April 8th. The reading is 0.2. We call it a reverse AD thrust. So in the past, when you see this combination of NASDAQ showing its weakest performance in 5 years, at the same time, the 4-day advanced 0.5% advanced decline line in the SP 500 is at 0.2. You know, 0.2, which means a negative. And we've seen this 6 times in the past. All good times to buy. For example, first time is March 27th, 1980, the day of the low of the bunker hunt crisis. You've seen it on September 11th, 1986, as the market was setting up for its final bull run into the 1987 peak. The market was up 43% with a 2.2% pullback. You saw it on the day of the low after the crash of 87, October 1987, where the NASDAQ 5-day rate of change was the worst in 5 years, and the S&P 0.5% AD line was as oversold as it was. You saw it on July 16th, 1998. After just a minor pullback in the market, people were panicking. It was a sign of a low. Market gained 88% before the next 12% correction, and the pullback was only 0.2%. And you had October 27th. There was a mini crash on October 27th, 97. Just a couple of days, we saw the signal then. Market gained 35% over the next before the next 12% correction with 0.0% pullback. And you saw it on August 31st, 1998, which was the day of the low of the S&P. After that bear market, they did test it in late September, but that was the day of the low. The market gained 48% with 0 pullback. So let's go back to your question. Have I back tested it? What would you think the answer is?
I'm going to assume yes. I'm
no. What you're seeing is a back test.
Yeah, that's right.
If someone wants to know, should I buy? Someone calls his advisor or a hedge fund calls his guru. Should I buy stocks today? I don't know. What's the Fed going to do? I don't know. It's way below its moving average. I don't know. The companies are losing money. We're ignoring all of that. We're saying, what is the market telling us? And the market is telling us, in this particular instance, it's telling us in March 27, 1980, after a 27% decline, September 11th, 86, right before a 40% move in the market, October 19th, the day of the low of the crash of 87, and the market, there are many reasons not to buy stocks, but the main reason to buy stocks is because our models are telling you this is the time to buy stocks. So as far as the back test, now you realize I'm not telling you when to sell stocks. All I'm telling you is a good time to buy stocks. When to sell stocks is a totally separate issue, nothing to do with this model. So someone will argue, well, I bought stocks in 1980 and I held it until now. No, that's not what this model is trying to do. This model is telling you when to buy stocks and when to sell stocks. We're going to get to in a moment. The key is, when do I want to buy stocks through hedge fund? When do I want to lever up and buy stocks? When do I want to be 100% long rather than 25% long? When do I want to lift my hedges and so on and so forth?
So right now, your model is telling us to buy stocks.
My model is not telling you to buy now. My model told us to buy on April 4th, April 5th, April 11th, and so up until August 13th.
But right now, we should be holding according to the model.
Right now, a model, if you're going to be trading on the model, you're still going to be long. There's no reason to assume that, but I have all this prepared to get to in a minute. I just want to show you how robust this model is. And I'm basically, what I'm trying to show is just using a small period of time from April to August of 2025, we're able to show, I'm only showing you a small portion of this model. I said there's 2,000 signals. We're only showing you maybe 15 or 20 of these signals. So let's go to another one. Let's go to, let's see what else over here. Let's go to, let's show this is very interesting. This is April 9th. April 9th was the day when I think NASDAQ was up 9%, SP was up 9% of the day. The low took place on April 8th. We got a signal April 4th and April 8th. We got many signals April 9th based on momentum of the low. This is one simple indicator. The Russell 2000 had 18 times as many stocks up as down on the day. The SP 600, which is the SP small cap, had 30 times as many stocks up on the day as down. Russell was up 6% on that one day, and the SP 4 mid cap is up 4%. So you have 4 separate momentum type indicators all occurring on the same day. Very, very rare event. Now, it's a rare event. It happened 3 times in the past. Let's see what happened in the past when this occurred. And I'm showing you I'm not picking out and saying, well, it's been bullish sometimes, but I'm showing you every single time this combination has occurred. And as you will see, it occurred on March 23, 2009, a couple of days after the low of the the bear market into 2009. I think this was the COVID crash, right? No, that's 2020. This is the 2009 bear market. This is it signaled on October 4th, 2011. After that, this decline is based on the German banks. They're thinking of going. There's talk about them going under. It bottomed on October 4th, 2011. November 10th, 2022. After the last bear market, 2022, and the market a few days after the low in the S&P, this signal, and April 9th, 2025. Basically, again, just take 4 types of momentum. We're combining it. Now, what I want to point out, David, you have many people on your show. I've seen many. I've been in this business quite a long time. I've seen many analysts, and I've never seen any analyst have this type of robust indicators. I see people talking in generalities. Mm-hmm. The market is washed out. Or they'll say, well, you hear this all the time. Every time you see a great rally like you saw now on April 9, 2025, they say, oh, bear markets always have the greatest rallies. You hear that all the time. Well, maybe that's true. The bear market has the greatest rallies, but the greatest rallies don't show 18 times as much upside in the Russell as downside, 30 times as much in the SP 600, and so on and so forth. We found indicators that tell you now is a time to buy stocks. And the last indicators you saw basically April 4th, April 8th, April 9th, and so on. So
just on the current situation here, I have a question on the differentiating factor between buying or holding. So you said now is not the indicator is not telling us to buy, but to stay long. What is the fundamental difference here between those two statements?
Okay, I'm saying it is this. If someone's going to, people are not in, let's put it this way. Let's look at my typical client, okay? My typical client is a hedge fund, right? A hedge fund, a multi-billion-dollar hedge fund, right? And they expect to be in the market for 10 years, 50 years, 20 years. They're going to give it over to their children or grandchildren to sell the company, and it'll be around for 100 years. Over the next 100 years, there'll be many, many opportunities in which you're going to you'll have a bear market or a decline or a breakout in which our models will tell them to buy stocks. They should buy stocks then. Now, I can't tell you today, for all I know, the market, it's up 38% off its April lows. For all I know, the peak took place today, and they're going to start declining. That's a separate picture. We're going to get that in a moment. But the point I'm trying to make is this is meant to be utilized at the turning points by people who want to make money. So it's quite possible that the market continues straight up from here, and we get new buy signals. I would tell a client to buy now with a stop, maybe 5, 6, 7, 8% stop, because basically we're still in a bull situation. But again, the point, what I'm trying to show is the market doesn't give you signals every day. You can't just, call up your advisor or call up your technician every day and say, what's the market telling you today? The market's telling me nothing today. But the market told me in April that we're headed for a big bull move, and I don't know if it's ended yet. I have no evidence that it's ended yet. If I have evidence that it's ended, we'll start talking about that, which is a separate issue. But and we're going to get that in a moment, how we model the sells. But that's really real for retail clients. For institutional clients, we have many factors we look at as to when to sell. These instances of when to buy. We have many things when to sell. But actually, for the retail, we've created a mechanical model. But I'll get to that once I see and once I feel that you've grasped what we're showing you over here. This is not a simple technical analysis. It's basically we've modeled the S&P 500 over a period of 75 years.
How is it that you're able to get the buy signals at every single bottom, local bottom and trough?
I don't get no buy signal occurred at every single bottom. For example, I randomly opened up this one, April 9, 2005. It didn't signal the bottom in 74. It didn't signal the bottom in 1962. It didn't signal the bottom in 2000. These models look for rare events that occur at market turning points. Some of it occur at this turning point. Others occur at other turning points.
Okay.
It's our combination of models. It's our hundreds of models together that is going to pick every single market bottom. There's no one indicator that's going to call every market bottom. Like there's no one indicator that's going to call every market top. You have these people out there who can tell you the market's been overvalued for 15 years, and that's the only indicator they use on a fundamental basis is overvaluation.
Well, I'll let you comment on when to sell, but just looking at your presentation here, it looks like there's several months, if not years, during which there's a buy period, if I'm not mistaken. So I guess that may give us some. No?
That's incorrect. Let me tell you why it's incorrect. It's incorrect because you're looking at this one model. Yes, this one model has only 4 buy signals. If you combine all the models together, we've modeled every 8% decline in the S&P 500 has a buy signal. I'll repeat. Every 8% decline or more in the S&P 500 has a buy signal that has occurred at least twice, 3 times, 4 times, or 5 times. Every single one. If you like, I wasn't prepared to do that. I can show you the dates of the. I actually will be able to show you something similar to that in a moment. So with the error that you're making here is you're looking at this model. Let me get one over here. You're looking at this. Say Milton Berg. This is great. This is great. You signaled in 82, 87, 2009, 2011, 2012, 2018, and 2025. But what about the rest of the time? What am I going to do then? Well, the answer is this model signals then. Not every model, other models signal at other market bottoms, you see? Mm-hmm. If you combine, even if you just combine, let me show you this. Go back to the first chart. Even if you combine the models I'm showing you today, which is only based on signals from April 4th to August 13th, even just these few signals we had from April 4th to August 13th shows far more signals than you've been pointing out. It signaled in 57, 62, 65, 70, 74, 78, 80, 82, 84, and so on, 87, 80, priced 87, 91. And this is only a handful of our models. We have thousands, almost 2,000 models in which modeling the market. Many are redundant, giving the same signals on the same dates. So just looking at this is really not even the full picture. It's just a small picture, a small piece of the pie. April 4th to August 13th, what did the market tell us? It had told us the same thing in the past. There were 104 dates in which the market has given you the same message it's giving you now. On all of those dates, it was a good time to buy stocks. The last signal we got was on August 13th, but the series of signals started on April 4th, through the end of April into early May, and that would have been an ideal time to buy, and that's when we were pounding the table to our clients to buy. Are we pounding the table now? No, because listen, let me just get to. I'll try to give you a little bit of what else we do, make it a little more robust. We have this is April 2020 buy signal projections. This is sent to our institutional clients. Okay, yeah. So on April we had quite a number of signals. You see, as you can see, all these signals here. And all these signals here, these are all April, okay? If you look at all the signals combined, the median minimum projection was 6504 in the S&P 500. The median maximum projection, meaning you look at the maximum gains of all the signals and you take the median of those maximum gains, it projects to 7,042.87 in the S&P. We're not there yet. So it's quite possible the market gets up to 7,042. So this is what we show for projections. That wasn't the point of this, what I'm trying to do now. I'm just trying to show you the robustness of the model, when to get in and when to go long. Now then we have signals in May. That was April. Signals in May. We have these signals here in May. And, the same thing I show you. S&P declined 5%, held low for 10 days. 5-day volume is greatest in 375 days. The S&P is below its moving average. The NASDAQ 10-day rate of change is the greatest in 504 days. That was on May 5th. In that instance, the minimum projection is 7158. The median projection is 8,086. But on average of all of these signals in May, we've met the median projection, which was median minimum projection was 5912. We've met the median maximum projection the median was 6,400.57, the median, and the maximum is 7,135.82. We're not there yet. There's another 4% in the market. So there's far, we only have an hour or a little bit over an hour to discuss this. It's far more to show you. But the point I'm trying to make is I spent 10 years working on models for the S&P. People are afraid to buy at the end of a bear market, whether it's a hedge fund, whether it's a retail investor. They capitulate. They may have held stocks for 5 years. But you get a COVID crisis or you get a bear market and they sell based on the headline news. The Fed's going to tighten. There's a recession. There's going to be a war and so on and so forth. And what we have is created models based on market action itself, on market data itself, telling you when to buy and giving you projections based on each signal of how high the market has gone in the past. We're not getting to the sell at this moment, but basically that's what we're showing. Okay. Now, I guess this is enough. I can show you more, but maybe you've seen enough. I don't know. I just want to.
I think that's a very thorough recap of your model. So I think investors right now are just looking forward to your guidance. We're looking for your guidance on what to do exactly. But you've explained that right now is holding, right? We're not.
Well, let me tell you further. Let me tell you even more than that. Okay, I'm going to give you exact guidance. We went short for our institutional clients, and we covered our shorts at the day of Thursday, November 20th. November at the day of the low. I'll show you what indicators we use for that. For retail clients, which we don't have any retail clients, we're going to start having retail clients. We're going to publish a newsletter, a very inexpensive newsletter, $10 a month, for long-term investors that have IRAs and they want to know when to be invested and when to be in cash. So this is good. This is that model. Okay, this chart is showing you that model. Let's see if I can do that. Let me move over and give it a little more room. Okay. Now, what this model does is it buys. We have thousands of signals. It buys at the first signal. Okay. In other words, if you're out of the market, its first signals, it buys it. We get series of signals, 5, 6, 7, 8, 9, 10 signals. This model is meant to buy at the first buy signal. It holds and holds and holds until the market declines 8% or more. In other words, if I bought in 1957, the market was up 45%. I'm holding until the market declines 8% from its peak. Now, what's the logic in that? The logic is many investors are scared out when the markets decline 3%, 5%, 7%. What we did is we really said, if you want to prevent an investor from holding stocks in a bear market of 25, 30, 35, 40, 56%, which we've seen over the last few decades, what's the best strategy to get him out? The best strategy is not to look at the Fed. The best strategy is not to follow advisors. The best strategy that we could find, that we could model, was simply holding the S&P 500 until it declines 8%. When it declines 8%, you get out and you wait for the next buy signal. Now, since we've modeled every 8% decline, every 8% decline in the market, we're quite confident that if a client gets out at 8% and the market bottoms down 8.5%, that he'll get back in. This is the mechanical model, which shows the sales mean it's the total return of the S&P 500. Each buy signal is the first buy signal of the series of signals we get. Now, for institutions, of course, we deal totally differently. If you get a series of signals, we'll leverage up on a second signal. We'll sell puts at using the low price. For example, my first recommendation on April 9th to the clients was sell puts using the lows of the prior day. Markets up 9% because we felt those lows will hold, and they did. But for retail clients, the model is going to tell them you buy and you hold, and we'll tell you when to sell when the market's next out 8%. Now, just looking at the total return, let me show you what we've gotten with this model. This is the 8% MB Edge retail model. The S&P, the long S&P trades were profitable 90.9% of the time. Going back to 1957, if a client bought and held till the next 8% decline, till the model tells him to sell, his profitable trades were 90.9% of the time. His average gain per annum total return was 21.7%. The percent of time he'd be invested in the S&P was 80.8%. So 20% in the market, 20% out of the market. 80% in the market, 20% out of the market. When you're out of the market, you invest in T-bills. The average return for T-bills since 1957 has been roughly 6%. So we have, anytime you're out of the market, you're always making money. In other words, you're out of the market, you're in T-bills, you're making money. Combination of the 90% profitable trades in the S&P and the 100% profitable trades in T-bills gives you a 95%. So 95.4% of the time, the client will be making money. The average gain per annum has been 18.5%. The total return versus a 10.9% total return for the S&P 500 since March 4th, 1957. Current signal is a buy. See, current signal is a buy. We got the buy at April 4th, and we're going to hold it until the market pulls back significantly. We had a number of pullbacks, 3%, 4%, 5%, but we didn't get an 8% pullback in the S&P, so you still hold. If the market goes down 8% and the client gets out, he had an amazing trade. He got in April 4th, day before the low, and he got out after the first 8% decline. Now, this is the model in illustrated form. This is the model on a yearly basis. Following these, the key is, listen, I want to make what I'm trying to show. I'm not trying to models. I've heard models coming out of my ears from technicians and fundamentalists in the 50 years I've been in the business. This is not the kind of model you've heard before. Not kind of model anyone in your show has ever discussed.
All right, let me ask you this. So in your 50 years in the business, what were some of the biggest problems or I guess pain points for trying to model the market that other technicians or perhaps even yourself have encountered in the past that you're trying to fix here?
Okay, number one, the main problem is emotions, of course. So we're trying to create a model where you can say the model is meant to buy when no one else buys. The model is not meant to say, now things are fine, the market looks good, now you can buy. The model is meant to say things look terrible, now is the time to buy. So the first thing is emotion. When you have a model, you can overcome your emotions, especially when you see the history. Number two is, we have far more data now than I've ever had. When I started this business in 1978, I couldn't even get historical data. They didn't even have it. And as the years go by, mainly I have to give thanks to Ned Davis Research. I started with them in 1979. And they have really any data I need, I get from them, and I have my models built using their computer system. And we have far more data today than you ever had in the past.
Sure. Also,
there's been changes in the market. Now you didn't have ETFs when I started in the business for for 20, 30 years in the business. You didn't have ETFs. Now markets move sort of in unison. We're getting far more interesting signals than we ever got in the past. Getting far more momentum-based and breadth-based signals than you ever had in the past. And we've modeled for that as well. So your question was, is it difficult? Yes, it's difficult. Part of the difficulty is just believing that it can work.
So in other words, sorry, go ahead.
The academics tell you that you can't model the market. Even technicians tell you can't really model the market. You have to follow the trend. You can't model the market. I had to have that belief that you can model the market. Now I have the belief. All you need is 3, 4, or 5 indicators that prove that the market is inefficient. Once you prove the market is inefficient, then you use your brains or you use your time to analyze the market and find as many inefficiencies as possible. If I had no evidence at all that the market was inefficient, I would not waste 10 years trying to model the market.
Speaking of emotion, let's suppose I were one of your clients, Milton, and I say to you, well, let's just rewind the clock to April this year, where your one of your last buy signals was triggered. So you say to me, all right, the model's telling me, hypothetically, this situation, the model's telling me buy. That's what the indicator is saying. And I say, well, Milton, we just had a major market correction. Liberation Day happened. Things are looking bad, like your model is saying, but I don't really need your model to tell me that. I know things are looking really bad. I don't feel confident that things are going to recover anytime soon. It's just, when things are selling off, emotions are high, people are still in fear mode. How do you convince me, your client, to get out of fear mode and trust the model? What's the conversation you're having qualitatively?
I'm going to tell you a conversation. I'll tell you an actual conversation. I hope my client's not listening because he might be upset with it.
Well, just pretend you're a consultant. Yeah, there you go.
On April 4th, I started saying, wow, these markets are showing indications of a low, on April 4th. And then on April 9th, when the market was up 9%, the S&P, and you had You had 100 times upside volume versus downside volume. I got a buy signal with hundreds of precedents, various buy signals, hundreds of precedents. I said, you have to buy. And my client, on April 4th, when the market was down, he said, Milton, you're saying it looks getting starting to look over, so how's it possible? Things are just collapsing. On April 10th, after the 9% rally, he says, Milton, how can I buy now? The market's up too much. You see? So the point is, you can't really start thinking about whether the market's down too much or going lower or it's up too much. You have to see what has happened in the past. In the past, many lows are tested. So you're going to buy the market. It's going to go up 15%, pull back 9%. That's normal as long as you see it happen in the past. The point is you have to base your buying on something. Everybody has to base their buying on something. You can't base your buying on the fact that the market's doing well. That's the worst thing a person could do. And you can't base your selling on the fact the market's doing poorly. That's also the worst thing you could do. Some fundamentalists try to use value. Value doesn't work. Some fundamentalists try to use interest rates. Interest rates doesn't work. Some fundamentalists try to use Fed policy. As you've seen in the last few years, trading on Fed policy also doesn't work. The market bottomed in 2022 when the Fed was still tightening. So what works? What works is what I've discovered. What works is analyzing the market, getting to the inside of the market, finding aberration. I've written papers on the psychology behind this and the philosophy behind this. The point is that once you know the market is inefficient, once you have one or two pieces of evidence that the market's inefficient, it then pays to find as much evidence as possible. And what we found was the inefficiencies. It's not really an inefficiency in the market. It's actually, I consider an efficient market because the market's giving me signals of when to buy. Yeah. What greater efficiency than for the market to tell you now's the time to buy? Now, we talked about the time to buy. This is the actual year-over-year return for retail. So, for example, I've highlighted the down years in the S&P. Like 1962, the S&P was down on a total return was down 8.83%. The models up 18.55%. Now, how's that possible? We don't go short. Well, the reason is because the market bottomed in early 62. We were into T-bills as the market was declining. And we got into the S&P, at the lower as the market started rallying. So we're up 18 versus 8% decline. In 66, the market is down 10%. We were flat, up 0.85%. And a year like 74, the market is down 26.63%, and our model's up 20.1%. Why? Because we were out of the market from January till October, while the market was declining, and we got into the market on October 4th of 74, and then that's when the market rallied 20%. We're up 20%. This is really something that our retail clients are going to get. So this is the third thing. So number one, I would try to show you the robustness of the model. It's not one model. We've modeled the market on the theory that markets can officially tell us when we should buy. Okay, we haven't created a model to tell you precisely when to sell. So for this particular model, we'll say you're going to buy at the bottoms of the bear markets, or you're going to buy when you get a buy signal. You get a multiple buy signal, you do nothing else. Just maintain your 100% long in the S&P, and you sell when the S&P declines 8%, and you wait, see what MB advisor, MB Edge tells you, when will you wait for the next buy signal, and that's where you get long in the market. You're strictly trading S&Ps. You're not using leverage. You're not trying to find ETFs outperforming the market. You're trading the market and outperforming the market by trading the market itself.
Well, Milton, my last question is, are you interested in applying this model to other asset classes? I think a lot of my viewers would like to see the same thing for Bitcoin, gold, oil, for example, just to name a few.
Well, Bitcoin, gold, Bitcoin don't have the kind of robust indicators that the stock market has. You don't have the advanced decline line in Bitcoin, and you don't have corporate earnings that can affect markets. You don't have the trick, let's put it, the major asset class in the world is the stock market. In the capitalist system, the stock market will gain over the long term. People are always afraid of the bear markets. I'm also afraid of the bear market, but don't be afraid of the corrections. Buy at the right time. Market's down 5%. Don't worry about it. You had multiple 5% declines during the bull market. Market's down 3%. Don't worry about it. The talking heads on TV are telling you there's a depression coming. Ignore it. Once the market's down 8%, say, let me get out now and let's see what MB Advisors tells you to do. Let's see what the market tells us to do.
Some people are concerned maybe when a market goes down more than 8%, let's say 20% or even 50%, like a financial crisis, we're going to get Japan, which is to say the S&P is not going to recover until 20 years later. But
Japan
that's a discussion for another time.
One of the greatest market for models. Let me show you Japan. You mentioning Japan? It's a total fallacy. Look, let me show Japan. Let's see. Let me just show you something about Japan. People say Japan was a terrible market. Japan was a wonderful market. Look at this. Let me just get Japan for a second.
Yeah, the Nikkei.
Nikkei. Let me get the Nikkei. I'm sorry. Let me do it right. Let me get the Nikkei, and let me show you why it's been a wonderful market. During the period it was down for 25 years. Let me show you this market. Amazing market, Japanese market. For people to argue that you couldn't make a market in Japan is absolutely ridiculous. So go back to 1989, when the bear market began, December of 1989, right there. We'll go there, and we're going to make a log scale so you'll be able to see the moves better. Okay, your log scale. Now watch this. I'm going to show you something in the job. You see, you couldn't make money in the Japanese market. Let's say you got a buy signal over here. You made 18%. Let's say you got a buy signal over here. You made 29%, and you got out the next 8%, and you won't get back in until here. And the next 8%, you made 36%.
I see what you're doing.
Before.
Yeah.
So you don't need a market to go straight up for what we're doing. You need a market to do what markets do: be volatile, fluctuate, crash during recession, depression, deflation, rally during inflationary periods. The Japanese market was one of the greatest markets in which people made money. People I worked with, some of the greatest traders on Wall Street, made a lot of money in Japan while it was declining. Because look at these amazing 135% retracement rally. I mean, look at these amazing rallies you had in Japan. Unfortunately for me, the S&P isn't as volatile. I wish the S&P would be as volatile as Japan, because then our buy signal will gain far more before the next 8%
Well, then
decline.
just apply it to small caps, then I guess, Russell. I don't know.
Yeah, small. Yeah, well, Russell, it might make sense too, but we model the S&P, and you could trade the Russell based on the S&P model.
Very good.
We didn't model the Russell itself. Anyway, basically, I just wanted to give you some idea of what we're doing as far as the current market. Let me show you a little bit about the current market, okay? Because
please.
People want to know what we did, and I said for retail, the retail clients, which we don't have yet, would have been long on April 4th. They'd still be long, no question about it. And, with the average, only one round trip trade every 1.5 years, or maybe 1.25 years. Going back to 1957, retail investors are interested in looking at the phones all day and see what the market is doing and find out what the talking heads are doing. They want to be long the S&P during the bull market and out during the bulk of bear markets. And that's what we try to do by having modeled the market. However, let's see where we are, what we're saying to our clients. So let's look at this. November 20th was the day of the low. Forced to position long. See, I say forced because emotionally I didn't want to position long. But my models told me to position long. And these are not the same models I'm showing you. These are institutional models which are short-term oriented, not just long-term oriented. And so why did we do this? So we had an oversold oscillator extreme, and we had the VIX relative to 20-day average was its sixth highest reading in 40 years, which means with the S&P down less than 4%, the VIX buyers were panicking. The option buyers were panicking, while VIX relative to 20 average is the sixth highest reading in 40 years. So that told us basically that the market is not acting as it would when it's going to continue down another 15% immediately. Now, what we said was, here's the next one, volatile and oversold. The same thing that same day, November 20th. This report came out the following day. We showed this. This is the 1 day over 100-day volatility in the S&P. Okay, in other words, the volatility on November 20th was 409% greater than the average volatility over the last 100 days. And these red signs are in the past when it made sense to buy stocks. We showed the table. So basically, we had reasons to buy stocks. We were short. We had reason to cover the shorts. We were actually so basically, now yesterday we wrote the following report. This is for institutions. Institutions pay us, the retail clients won't be able to get this type of information. It's only for institutions. Yesterday was a minor new high, no breakaway action. Had a new high in the banks, new high in the Russell, new high in the SP 600. S&P failed to make a new high as the Nasdaq did, but the underlying action was not breakaway. You didn't see the type of upside volume, didn't see the type of upside breadth, especially our 0.50% breadth measurement did not show any extremes. So we felt, since we said in our previous report, I'll write it right here. Let me show you what I wrote on the bottom. Over here, I wrote, where did I write that? We expect at this time, we cannot at this time consider the gains of the November 20 low as anything more than an oversold bounce of little technical significance for the intermediate term. In other words, we got a bounce. SP is up 5%. Russell was up 8%. Banks up 13%. But since you don't see break reaction at the highs, it might strictly be a test to the high and the market's going to go low. So institutions, we're still 100% long for institutions, not leveraged long. We got long November 20th. But it's quite possible the next few days we'll start lowering our exposure. But for the retail, for the millions and millions of retailers out there, if you bought it on April 4th or April 5th or April 9th, and you're holding the market, don't worry about what Milton Berg tells his institutional investors. They're a different class. You want to make money in the long term, and if you can just hold your longs till the market's at 8%, then you get out. And this way you'll know you're not going to be sitting on your positions during a 50% market decline, and you just wait for the next buy signal. But
Excellent.
for institutions, again, we're cautious now. I'll show you our technicals at the high. I'll give you something else we look at too. I'll show you something else. It should be in here, yeah. This is it. You see? We looked at every major market peak since 1966. For example, the S&P declined 22% in 66, 36% in 68, 48% in 74, NASDAQ declined 29% in 98. This is a list of all the bear market declines, and this is the technical data that occurred at the day of the peak, okay? So every time the market's at a new high, we reissue this report. It's 4 pages. And we say if it's yellow, it's consistent with what you've seen at previous market highs. If it's pink, it means it's inconsistent. Usually during a bull market, you see many, many pinks. Even though the market's making a new high, the breadth is too strong, the number of too highs is too great. But for example, at the last high on December 4th, when the Russell made its high, this is not including yesterday's action. The S&P only had 24 new highs, okay? So that's very consistent with what you see at the market peaks. The market, in a bull market, you see 100 new highs, 150 new highs. Or, we track trend, we track AD lines and so on and so forth. So there's a lot more to what I do than what I'm showing you. I'm just trying to show you a way of modeling the market, something that I don't think anyone else has ever done. I don't think anyone else ever attempted. And the only reason I attempted, I gave away 10 years of my life to try to analyze these markets. Believe me, it was a lot of work. I didn't use AI. I didn't have AI at the time, and AI wouldn't even help. I really followed the market using the data from one day to the next, to the next, to the next, to the next, seeing what the data showed me visibly, using my own eyes to do it. So I was able to model this market. And now I think I've been a success. I think I've been pretty successful. And again, I wouldn't have attempted it if I felt the market was efficient. Once you can find 1, 2, or 3 inefficiencies in the market, you know the market's inefficient, and it pays to delve deeper. And that's what I did. And I just showed you really a little bit of what I've done, because all I did was show you what signaled from April 4th to August 13th. If I show you what signaled from 1957 to 2025, it would take weeks. And,
yes.
There's really no way to do that. Okay, David, I hope I made myself clear.
We're gonna wrap up here, but that was a very good, thorough explanation. Thank you very much, Milton. We can save the rest for another discussion, but tell us where we can find your work right now.
So the point being, we're on Twitter at @BergMilton. I think it's called @BergMilton. We also have a website, www.miltonberg.com. We have an email, info@miltonberg.com. And again, hopefully the next few days we'll publish our retail letter, which will not be you're not going to have all the information. It's going to be a buy signal, and you're going to hold for a year and a half, hopefully, or for a year or 6 months. It's not going to be, there won't be much information in the retail letter. We're only going to charge $10 a month. We might have a higher class, maybe $1,000 a month for someone between retail and institutional. But right now, I just want to get this across. I think it's very valuable, and I don't want to just keep it for myself. I want to try to make money on it, but I also want to share it with the public, because I think most of the public out there really, they get it, they have their IRAs and they get into the S&P or they get into the ETFs. I think it should be a very good product for them. They don't have to worry. They don't have to lose sleep at night. And they know they're invested in the greatest companies in America, the S&P 500. And when there's a bear market, they'll generally be out of the bear market. Okay, that's basically it.
Okay, great. Thank you very much. We'll put the links down below so you can follow Milton. And thanks again, Milton. We'll speak again soon. And thank you for watching. Don't forget to like, subscribe.